Good afternoon, options traders. I just wanted to put out kind of a quick alert about USO, or the US Oil ETF, and the unusually high tilt that's going on, because I know a lot of people in the group are trading oil because of all the craziness, the negative prices that we've seen during coronavirus. But you have to be careful with the options, especially when you're dealing with very steep skews and tilts. So let's take a look at what that means and how you can find it. So over in the E-Trade platform, I'm going to start with Microsoft just for an example here. Stock is trading for about 172. I don't have an exact 172 strike here, but I do have a 172.5, so that's going to be our closest for at the money. Now take a look. If I look at the call side over here, there's no intrinsic value. It's $8.25. That is pure extrinsic value. And if this were exactly an at-the-money option and there were no skews, if you look directly across the board, we would see that the puts would have exactly the same extrinsic value, not counting the cost of carry. Now, the reason it's a little bit higher here is technically this put is in the money a little bit. You can see by 48 cents. So it's not really a direct apples-to-apples comparison, but you can at least see they're pretty close in price. But if they weren't, if there was a real big difference between these, we would call this a put-call skew, meaning that we're just looking horizontally here, and if it was higher on the put side, which a lot of times it is, it would be negatively skewed, and if it occurred on the call side, it would be positively skewed. However, this is where it can get confusing, we can look vertically, and these are actually called positive negative skews, but don't confuse that with the put-call skew. So for instance, if I go 10 points in the money, let's say down to the 162.5, and I look, there's about 475 of extrinsic value. Well, if I go 10 points out of the money, we should have about the same. So let's come up here to the 182.5, and there it is, 410. So the 162.5 had 475, this has got 410. This is what we call a positive negative skew. So here we would be negatively skewed, at least on the vertical axis, because theoretically those should be the same. But there's another skew that traders either don't know about or forget about, and that is a horizontal skew, or what is called a tilt. And that is looking at a given strike at different expirations. So if we were to look at the 172.5 strike across different expiration dates, are we getting skews here? Theoretically, these should be separated only by the cost of carry. In the real world of trading, though, that's not true. It depends on where traders are stacking up based on supply and demand. Where are the real needs? So we can look at a kind of an idea here by looking at a series of at-the-money options, couple of strikes in, couple of strikes out, and kind of get an average. And to do that in E-Trade, come all the way over here, click this little icon, and what you're looking at here are the implied volatilities with the solid line, and the dotted line is the 30-day average. So for Microsoft, you can see that regardless of which expiration we're on, that the current implied volatility, the solid line, is pretty close to where the average has been, regardless of where the expiration date is. However, that is not true when you get into the really volatile issues such as oil. So again, I know a lot of you are trading oil, so watch this. If we go over to USO, and if you click that icon there to look at our tilts, look at this. I mean, the average has been around 150, and it's pushing 400. If you go out one more expiration, you're comparing 140% to 325%. And so you can see that no matter which expiration you go to, you are paying an enormous premium for the extrinsic value. And you've got to be really careful here with the options. Because remember, that's the same thing as a point spread in a football bet. Just because you think your team's going to win doesn't mean you should lay a big bet in Vegas if there's a 25-point spread against your team. And yet that's kind of what's happening here. The amount of extrinsic value that you're paying for these options is so big that in order to even make that up to break even really means the odds are stacked against you. Of course, as you come out in time, which is very standard in the stock market. Normally we see our tilts very pronounced in the early months because this is where most traders, hedging transactions, everything is taking place. So what can you do here? This is a great time to make use of things like diagonal spreads and vertical spreads. But the main thing I wanted to show is that if anybody in here is trading USO, just buying calls or puts, you have got to be incredibly careful in your analysis and make sure that you understand what you're stepping into, because unless you are expecting super big, fast, aggressive moves in this underlying, chances are these are going to end up as dead losers. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.